How is everyone doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, we're going to be continuing the crypto series with installment number 22. I've got a ton of crypto updates for everybody today. We are going to jump into all of the stories here. So we've got crypto kidnappings. We've got crypto executives going to jail for 12 years. We have crypto legislation being passed through. We have more money being seized for crypto butchering scams. We have all kinds of crazy stuff going on here in the crypto world. So we are going to kick it off here with obviously Senate passes stablecoin bill in a big win for crypto industry. Legislation known as the Genius Act goes to the House before President Trump's desk. So the Senate passes the Genius Act, a bill to regulate stablecoins, a type of cryptocurrency pegged to fiat currency. The bill mandates $1 reserves for every $1 of stablecoins and compliance with anti-money laundering rules. The crypto industry donated $170 million in the last election. Passage is a win for Circle, a major U.S. stablecoin issuer. So basically, and again, I'm not going to read through the whole thing here, but the gist of it is, the Senate passed this bill. It's now going before the House. The House has kind of its own version of this, so I'm sure there'll be a couple of minor tweaks here. But I think this is no doubt. I mean, it's going to go through the House. It's going to go to President Trump. This is going to be a major step in moving forward with basically the legitimization of stable coins. And now we're going to begin the conversation of how are banks going to offer stable coins to customers? Are they going to offer custodial services? Are they going to create their own coin, as we're going to see from JP Morgan here in just a second? Or perhaps are they going to do, are they going to create digital wallets, allow customers to just hold the digital assets like this? So I think there's a number of different ways that banks can approach this. I think the custodial angle might be the best, but like I said, we'll kind of leave that for another day. So then it leads to this. So stablecoin legislation will juice demand for treasuries to a point. So issuers of digital currencies need treasury bills for their reserves, but analysts say the consequences are uncertain. So the Senate has passed this legislation. Treasury Secretary Scott Bessent said new demand for short-term treasuries as backing for stablecoins could reduce government borrowing costs and rein in the national debt. Maybe. Analysts are debating the magnitude of the stablecoin impact. So, So the cryptocurrency industry scored a major win Tuesday when the Senate passed the legislation, which many expect to spur adoption of businesses ranging from payment providers like MasterCard and Visa to big merchants, including Amazon and Walmart. More on that again in just a second. And because stablecoin issuers back their currencies with short-term treasuries, and many expect them to buy more in coming years, that could help lower borrowing costs, not only for the government, but also households and businesses. Yields on treasuries serve as a benchmark for interest rates on mortgages and other loans. A thriving stablecoin ecosystem will drive demand for the private sector for U.S. treasuries, which back stablecoins. Treasury Secretary Scott Bessent said Tuesday in a social media post, this could lower government borrowing costs and help rein in the national debt. Many Wall Street analysts agree that the growth of stablecoins could boost demand for ultra short-term U.S. treasuries in particular, but they say the magnitude of that effect is highly uncertain. First, the future for stablecoins is still unclear. Second, money flowing to stablecoins could come from other sources such as money market funds or bank deposits, which already support demand for treasuries. Stablecoins are primarily used by traders and investors to buy crypto on exchanges, although they could increasingly be used for other financial transactions, with banks and retailers among those exploring their own potential uses for the digital token. The dominant stablecoin issuers, Tether, and Circle, keep the value of their currencies pegged to the dollar by holding short-dated treasuries as collateral, along with other cash-like investments. Tether also holds some Bitcoin, corporate bonds, and precious metals as part of its reserves. So there you have it. So this is going to lead to a lot of interesting things. The first of which is how much of an effect is this going to have on the treasury market? We shall see. JP Morgan Chase to launch Deposit Token. It will be the first token of its kind on a public blockchain, enabling fast, secure 24/7 money movement between trusted parties, according to a post by Coinbase's blockchain. So JP Morgan Chase will soon bring banking to the blockchain with the launch of its stablecoin-like token for institutional clients, the JPMD. The USD deposit token, which will serve as a digital representation of commercial bank deposits, will soon debut on Coinbase's public Ethereum-based blockchain. The permission token will only be available to JP Morgan's institutional clients, differentiating itself from publicly available stablecoins like PayPal's PayUSD and Circle's USDC. It will be the first token of its kind on a public blockchain, enabling fast, secure 24/7 money movement between trusted parties. JP Morgan chose Base to take advantage of sub-second, sub-cent transactions for their clients, giving institutions access to near-instant settlement and real-time liquidity. Moving money should take seconds, not days. Commercial banking is coming on chain. So, and again, and I would basically tell people that this is just the first step for JP Morgan. JP Morgan's been, they've kind of been messing around with their own cryptocurrency, their own tokens. They've been experimenting with blockchain technology. I mean, JP Morgan has an annual IT budget, I think, of like $13 billion a year. So they're working on a lot of stuff over there at JP Morgan. So I think this is just them, dipping their toe in the water. I think they're going to use this as a base case for a lot of testing for future, rollout of future products. So we'll keep an eye on that. Walmart and Amazon, as we said in the article a few minutes ago, Walmart and Amazon are exploring issuing their own stablecoins. So corporate coins could take payment activity away from banks and the traditional financial system. So stablecoins could save merchants billions in fees and offer quicker payment processing. Decisions hinge on the Genius Act's regulatory framework for stablecoins currently debated in Congress. But again, just the fact that Walmart and Amazon are looking at this and considering this, that again could be a game changer. We'll have to keep an eye on that. Businesses are also binging on crypto, dialing up the market's risks. About 60 companies with no prior ties to the crypto market have embraced the so-called Bitcoin treasury strategy popularized by Michael Saylor. Companies unrelated to crypto and buying digital assets to boost their stock prices, a trend pioneered by Michael Saylor's MicroStrategy. Industry insiders warn that this trend could expose crypto to new risks, amplifying sell-offs during market turbulence. Wall Street is financing these crypto purchases, but some analysts believe only companies led by industry figures can withstand the downturns. So again, very interesting fad here. You have a bunch of companies that are basically buying into this whole, Bitcoin treasury strategy. And then obviously Michael Saylor, his company MicroStrategy, which, is invested heavily. I think they've got billions now in, invested in crypto and specifically Bitcoin. Whether or not this is a big strategy or whether this is really going to pay off or whether this is going to act as a quasi gold-like hedge, I don't know. I don't know. Again, it's an interesting fad at the moment, but we need a lot more time and a little bit market cycle to see kind of what, if anything, if that really works or doesn't work. Keep an eye, again, something else to keep an eye on, right? Okay, DOJ seizes a record $225 billion in crypto tied to global pig butchering scams. So the Justice Department announced the seizure of $225 million in crypto. It is the largest ever seizure of crypto linked to confidence schemes known as pig butchering. The DOJ thanks Tether for aiding the probe and urging more victims to come forward. So yep, the Justice Department announced Wednesday the largest ever U.S. seizure of cryptocurrency linked to so-called pig butchering. Federal prosecutors filed a civil forfeiture action targeting more than $220 million in cryptocurrency traced to a sprawling web of fraudulent investment platforms. Victims were tricked into believing they were investing in legitimate crypto ventures only to be scammed by criminal networks, often operating overseas. So there you have that. And then Shares of Coinbase and Circle surge after stablecoin bill passes the Senate. So Circle, obviously, like we said, is the issuer of the USDC stablecoin, jumped nearly 20% after the Genius Act passed the Senate. Coinbase, which co-founded USDC and earns 50% of its revenue with Circle, rose almost 10%. The Genius Act could spark explosive growth in the nearly $260 billion stablecoin market, even as broader crypto prices remain under pressure. Yes, undoubtedly. Celsius's Mashinsky, former crypto high roller, gets 12-year prison sentence. So Mashinsky pleaded guilty to fraud in connection with the firm's multi-billion-dollar collapse. So if everybody remembers during what is now known as the crypto winter of 2022, I just call it the crypto collapse of 2022. Celsius was one of the main companies that went down in a blaze of glory that year. And now the gentleman who was the co-founder, so Alex Mashinsky, Celsius Network's founder, was sentenced to 12 years in prison after pleading guilty to fraud. Celsius, a pseudo bank, collapsed after a downturn in crypto markets, leading to Mashinsky's arrest and charges. Prosecutors said Malinsky misled customers, took undisclosed risks, and made $48 million in profits from CEL tokens, funding personal luxuries. So former cryptocurrency evangelist Alex Malinsky was sentenced to 12 years in prison on Thursday after pleading guilty to fraud in connection with the multi-billion-dollar collapse of his firm Celsius Network 3 years ago. A pseudo bank that touted returns of as much as 18.6% on customers' crypto deposits. Celsius was one of the first big crypto companies to topple in bankruptcy after a downturn in the digital currency markets began in the spring of 2022. Federal prosecutors had sought a sentence of at least 20 years for Mashinsky, who attracted customers, many of whom ordinary investors, by urging them to unbank themselves and park their savings at Celsius during frequent appearances on social media. At its peak, Celsius managed more than $20 billion, and hundreds of thousands of customers entrusted it with their money, according to a sentencing memorandum filed in late April by Manhattan U.S. Attorney Office, which led the prosecution of Mashinsky. So, again, another original crypto high roller bites the dust here. Maybe they could put him in jail next to Sam Bankman-Fried. Maybe they could be bunkmates and like hang out together. Yeah, they did have SBF. Yeah, he was in jail with Diddy. I guess they could put these two together, right? They could talk about how they ripped, how many people they ripped off. Gotta love it. Okay, now the last three articles here today, this is crazy. This is all around basically kidnappings. People are going around now for, if people figure out that you have large amounts of cryptocurrency holdings, you better be very careful, because you could get kidnapped or beaten up or robbed. I mean, it's kind of crazy. So why cryptocurrency holders are being targeted with kidnapping? It's fairly reasonable to assume that the vast majority of attacks are never publicized, one cryptocurrency expert said. So as celebrity Twitch streamer Caitlin Siagusa, better known as Amaranth, if I'm saying that right, Amaranth, slept at her home in Houston. 3 men broke in and pistol whipped her, demanding she hand over her cryptocurrency. What the thieves didn't know was that her husband, Nick Lee, was in the bathroom. Lee emerged with a firearm and fired at the men, causing them to flee. The March 2nd incident is just one in a recent string of crimes that have prompted authorities to warn investors in cryptocurrency and people owning large amounts of digital assets about their vulnerability to kidnapping and robbery. Elsewhere, a kidnapping attempt was caught on camera and broadcast by Le Parisien media outlet. It showed footage from a May 13th attempt to abduct the relatives, a 34-year-old woman and her 2-year-old daughter, of a cryptocurrency investor. Jameson Lopp, the chief technology officer of crypto asset custody solutions firm Casa, has compiled a database of physical attacks that show 23 reported incidents so far this year, compared with 32 for all of 2024. Lopp said he believes several people have been targeted because they flaunted their crypto wealth on social media. Amaranth, for example, who was hit in Texas, she almost assuredly got hit because she posted a screenshot of her wallet that had 20 million worth of Bitcoin in it, he said. While most U.S. banks will ask customers to give prior notice before withdrawing large amounts of their accounts, this extra precaution is often unavailable in the digital asset space. Dave McKelvey, a former detective chief investigator in London's Metropolitan Police, who now runs an investigation company, TMI, said the flaw with digital assets is that once criminals have access details to a crypto wallet, they can take everything. So again, this is kind of wild. Here we go. Here's another one. Second crypto investor surrenders in Manhattan kidnapping torture case. His surrender comes 4 days after the victim, a 28-year-old Italian national, managed a dramatic escape from a Soho residence. So a second cryptocurrency entrepreneur has turned himself into police in connection with the alleged abduction and prolonged torture of an Italian man inside a luxury Manhattan townhouse, authorities said Tuesday. William Duplessis, I guess I'm saying that, Duplessis, 32, faces a range of charges, including kidnapping, assault, unlawful imprisonment, and criminal possession of a weapon, according to police. The Manhattan District Attorney's Office didn't immediately return a request for comment, but his surrender comes 4 days after the victim, a 28-year-old Italian national, managed a dramatic escape from the Soho residence where he told police he had been held captive, beaten, and threatened for nearly 3 weeks. Duplessis' arrest follows that of John Waltz, 37, another crypto investor who was taken into custody the morning of May 23rd after the victim, bloodied and barefoot, fled the townhouse and flagged down a traffic agent for help, according to the Manhattan District Attorney's Office. Both men have been described in the online profiles and interviews as entrepreneurs deeply involved in the cryptocurrency industry, with Duplessis listed as co-founder of Pagani Blockchain Fund and Waltz as a blockchain investor with ties to Silicon Valley and Kentucky's crypto mining sector. Waltz also described as a Silicon Valley investor and former board member of Sprocket, a nonprofit economic development organization and entrepreneurship hub based in Paducah, according to a 2020 interview with the Paducah Sun. This is just getting insane, And then finally, last article here: severed fingers and wrench attacks rattle the crypto elite. So as Bitcoin soars, investors and executives are taking their swollen digital wallets offline for safety. Criminals are coming after them violently. So in Paris, the screams echoed down the narrow streets in a trendy neighborhood here nearby Thursday morning. Help, help, help. 3 men in black masks had jumped on a 34-year-old woman whose father runs Paymium, a French cryptocurrency exchange. Brandishing canisters of mace and what looked like a gun, the masked men attempt to force the woman and her toddler into an idling white van disguised as a delivery truck. But her husband threw himself between his family and the attackers while a neighbor hustled away their child. "Let go of me," the woman yelled as the assailants bludgeoned the husband. His head been splattered with blood in videos taken from nearby buildings. With other neighbors closing in and a shopkeeper ready to throw a fire extinguisher, the would-be abductors jumped in the back of the van and sped off. The brazen attack was the latest in a wave of violent abductions around the world, including several in the U.S. targeting crypto executives and their families. Victims have been pistol whipped, abducted, and in 2 cases had fingers severed. The criminal's goal: millions of dollars in ransom and cryptocurrency. The assaults are often called wrench attacks because they rely on simple tools for inflicting pain to coerce victims rather than sophisticated tools for hacking them. Hacking has long been the primary risk for the crypto rich, but to thwart hackers, savvy cryptocurrency investors are increasingly taking their digital wallets offline in favor of physical devices, making remote theft more difficult. Real-world crypto crime bypasses those safeguards. A lot of people are getting to the hide your gold under the mattress level of security, said Jameson Lopp, the co-founder of Bitcoin security company Casa. But if you are a high-profile person, that's when you have to worry about the physical attack. Those concerns intensified this week with cryptocurrency exchange Coinbase disclosing that as many as 97,000 customers have had their personal information stolen, including addresses and balance snapshots. The company said the data was likely stolen by bribed contractors or employees working in customer support, and that it had refused a $20 million ransom demand. Another factor motivating criminals: cryptocurrencies have surged in value, with Bitcoin up 54% in the last year, minting a whole new array of potential deep-pocketed targets. So again, it's just, this is just wild. So again, be very, very, very careful out there. I can't stress enough. I mean, you just have to be extremely careful if you're investing in cryptocurrency. Yeah, keep an eye on what's going on there. Try to keep your digital wallet as private as you possibly can. Don't be on social media posting how much you own or what you're trading or what, like, don't do that. Just don't do it. You may end up with a bunch of guys popping out of a van one day, beating you over the head with a wrench. Yeah, that's crazy. Um, okay, there you have it. I know we covered a lot here in this episode. There's a lot of stories, but there is just an insane amount happening in the crypto world. And a lot of stuff is going to happen. Obviously, this Genius Act is a game changer. We're going to have to see what happens with all this tokenization. What are banks going to do here in the coming weeks and months in the coming years? There's going to be a lot to figure out here. So, but anyway, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below. And as always, check out some of the other content on the channel, especially some of the episodes in the crypto series if you haven't seen any of those. I hope everyone has a great day out there, and I will see everyone again real soon. Thanks a lot.